we should all be concerned about Omicron, but not panicked. If you're fully vaccinated, and especially if you got your booster shot, you are highly protected.
We are taking Omicron very seriously, as you would expect us to. But at the same time, we are confident that we'll be able to continue to ensure we can face down the most recent challenge.
We don't think today that there is enough evidence to justify any tougher measures before Christmas.
This is Bloomberg Surveillance, Early Edition with Francine Lacqua.
Well, good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Here's what's coming up on today's program. Joe Biden says Omicron will result in more breakthrough infections amongst the vaccinated and that a winter of severe illness and death awaits the unvaccinated. Boris Johnson rules out more curbs before Christmas, but warns new restrictions are possible afterwards. England cuts its COVID isolation period from 10 to 7 days. Plus, Europe's energy crunch deepens. Prices soar to fresh records, threatening to derail the continent's economic recovery. Now, first thing is first, so let's check in on the markets. And we did see quite a lot of volatility. I would say swings across the board. Today, we're seeing thin volumes. Remember, it is December 22nd, which means that a lot of traders will have taken some time off. European stocks pretty much unchanged. I'm looking at basic resources, one of the biggest losers, 0.4% lower. And then the Turkish lira. I mean, we call it, a wild ride, but really it's something like I've never seen before, currently at 12.53, and talk about gyrations. I mean, if you look at what Turkish lira has done over the last 6 to 7 weeks, it's just absolutely incredible. Let's get on to the European map to see whether there's a difference between the CAC 40 and the FTSE here in the UK, or whether Italy is holding on to some of the losses that they've been seeing. So this is what we're looking at the moment. So you can see the UK, the FTSE down 0.2%. We're seeing similar moves, actually, with the DAX pretty much flat, the CAC 40 gaining 0.2%. So it does seem to be pretty range-bound. We're trying to figure out inflation, 2022, and so what Omicron leads to in terms of restrictions or not. So many leaders are warning about the threat of the Omicron variant. They're also trying to make sure that their economies don't take a severe hit in the run-up to the holiday season, a time of peak earnings for many sectors, including hospitality. Well, let's take a closer look at how Omicron is affecting economic activity. Our Bloomberg economy reporter, Lizzie Birding, is standing by here in London. Our Berlin bureau chief, Birgit Jennen, is also in Germany, and Bloomberg markets editor, Christina Kino, joins us as well. So, Lizzie, let's kick it off with you. Boris Johnson ruling out stricter pandemic rules before Christmas, but said there could be more in 2022.
Yeah, well, he's caught between his scientific advisors and his mutinous MPs. On the one hand, COVID infections are at record levels in the UK, but that's not yet translating into hospitalisations. But the risk is, if he leaves it too long, it could overwhelm the National Health Service. On the other hand, the last time he tried to bring in new COVID restrictions, he faced a record rebellion. And the only reason they passed was because of support from the opposition Labour Party. So it's a difficult political situation. But on the other hand, there's a potential economic cost to not acting. Bloomberg Economics sees up to a 2.2% hit to GDP if modelling bears out from the London School of Hygiene and Tropical Medicine that there could be 75,000 more deaths from COVID by April if restrictions aren't tightened. So what you could see is a compromise situation where we go back to step 2 restrictions, which, for instance, include pubs and restaurants not being able to serve indoors.
Lizzie, thank you. Birgit, bring us up to date with the latest situation regarding Omicron in Germany.
Yeah, the government has basically yesterday decided to tighten the curbs. They are introducing, just for New Year's Eve parties, that only 10 people should be allowed, and also they are closing clubs and discos, and big sport events should not be taking place with public. So these are sort of certain kind of measures they are hoping to basically break the next wave of Omicron. But we already hear from the Federal Health Institute that they say this is not enough, because they actually had called in advance of yesterday's meeting for much further restrictions. So what is going to be happening is that already in January the 7th, the states and Scholz are going to meet again to possibly discuss further measures.
Thank you, Birgit. Christine, how are markets handling the virus situation?
Well, Francine, markets are very much on standby for any headlines related to Omicron. I think what we're seeing in markets is very much a vulnerability to any headlines that could change the game moving forward. Just this week, we saw markets starting the week on a risk-off note because there was news of potentially widespread lockdowns in response to Omicron. But then that quickly turned when we saw more encouraging results from Moderna with regards to its booster. And so really what we're seeing is sentiment is very, very vulnerable to any changes, any potential twists and turns when it comes to the Omicron story, whether it's negative or positive. And we're likely to see more swings and shifts, especially as we head into a period where there's very low liquidity, very low volumes.
All right, thank you all. Our Bloomberg economy reporter, Lizzie, our Berlin bureau chief, Birgit Jenin, and our Bloomberg markets editor, Christine. Now, coming up, we discuss more on the markets with Janet Moy from Brewin Dolphin. This is Bloomberg.
While this variant is significant and the impacts are powerful, I do still, as you said, have my rose-colored glasses on heading into the new year, because below the surface, there is still a lot of opportunity.
The undertow, at least with each successive wave, seems to be weaker. And we're on a very, very strong footing, financially and economically speaking. And so we think that the markets and investors will be able to withstand that.
Even as central banks look to tighten up monetary policy a little bit, because if inflation's high, people aren't going to be looking to the bond market for inflation hedge. That could still keep some attractiveness in the equity markets.
We're going to be focused in on where demand is in 2023. We think it's going to be more moderate, and we're taking a somewhat less risky approach to investing.
We had this year very, very high GDP growth all along, very low base effects. We will still have them with us in the first half of next year, but it will be a year of two halves. So the second half of next year will already be sort of more normal. In other words, you could also say slower.
Some key market participants there speaking to us on Bloomberg TV about the Omicron variant and striking a pretty upbeat tone for investments as we head into the new year. Well, joining us now is Janet Moy, investment director at Brewin Dolphin. Janet, good morning, first of all, and what's your boldest call for 2022?
Hi, good morning, Francine. Thanks for having me. We're still optimistic on the macro and markets outlook heading into 2022. What we think is that, currently we have this Omicron risk, which poses near-term uncertainty. But we think that this should get better as we head into next year. We have, health breakthrough. We have, COVID pills available. We have more booster jabs. And it seems that this variant is milder. So we still retain an optimistic tone. And we see that central banks are tightening their policy, but it is a gradual hiking cycle, which we think businesses and consumers can withstand. So overall speaking, we are still overweight on equities, and we're happy with that position. We prefer the U.S. As we are in a slower growth phase of the expansion cycle. And we think that bond yields should pick up still modestly. But it shouldn't be deterrent to the current equity risk rally. But overall speaking, we expect a bit more volatility. It's not going to be a smooth sail as compared to this year. But still, we think that it will be a pretty positive outlook still.
So, Janet, what's your take overall on what treasuries will do? And is there anything that you'd buy on the yield curve, or actually it's just a selling off point at the moment?
Yeah, we do think that the yield curve will flatten, given that monetary policy is tightening, so the front end of the curve is reacting. Whereas the longer term maturity, we think that there is still support, because I think a lot of institutions are still buying. It is still offering a relatively attractive yield versus to the other developed markets bonds such as bonds and JGB. So we do think that the longer term yield, it will rise modestly given that the economy will continue to recover, but we think that it will remain anchored at lower levels than compared to previous cycle. So we do think that overall speaking, the yield curve may flatten a bit out there in 2022.
Janet, talk to me a little bit about what you're expecting from the Fed and what that means for dollar dynamics and dollar strength.
We think that the Fed will have a gradual hiking cycle. It is currently expecting, about 6 rate hike over the next 2 years or so. Although markets are not as optimistic, I think they don't expect as much rate hike in 2023. So what we think is that the Fed is right to have a more hawkish tilt at the moment, given we have a very high inflation print. But what we think is that the Fed may change their stance towards the later part of next year or into early 2023. And the reason why is because the inflation dynamics could actually slow down in the later part of next year. And also growth are likely to slow down as well. So central banks are being very reactive to what's happening to inflation at the moment, which is rightly so. But if inflation does come down, which, mathematically, energy prices stabilize, then we think that the central banks may actually turn their stance. And with regards to the dollar, I mean, the relative interest rate differential supports the dollar because in the euro area, we know that the central bank is the most dovish out there. They're not going to move rates at all. And in fact, they're still keeping the quantitative program. They're still extending that. And so we think that interest rate differential should support the dollar, at least marginally. But we have seen a lot of those moves already, and traders are already positioned for that. So we're looking for modest upside for US dollar, not like a huge upside.
Janet, among the big central banks, is the Bank of England, after the surprise that we had just a couple of weeks ago, the most interesting one also for 2022?
Yeah, it was a little bit of surprise. We think it was a close call. What we think is that, again, the Bank of England may be like the Fed. It may change course as well. It is reacting to the current high inflation. And it is still being cautious on the economy. I think they raised interest rates because they saw a pretty good set of labor market data, and they saw a pretty good set of retail sales data as well. But, that may change with the Omicron risk. The UK, we're facing one of the biggest challenge with regards to Omicron. We're seeing cases rising, hospitalization rising in London, and lots of businesses are seeing cancellations. So, and we also see the GDP growth in October already slowed down. Very likely, we may actually see a contraction in the fourth quarter, actually. So they may change course if they see that the economic risk is materializing more than they expected at the December meeting. So they are currently, I think markets are currently pricing in about 4 rate hikes. So that may not materialize. We're looking probably for, less than that, maybe two or 3.
Do you think the market, Jan, is actually underestimating the kind of impact that a different Chinese growth will have on the world economy?
I think that markets are relatively sanguine and complacent about what Chinese growth slowdown will do to the world economy. And I actually think rightly so. I think China growth will slow, obviously, but actually the recent moves by the authorities suggest to us that they are managing that slowdown. So the economy is likely to stabilize or slow down modestly rather than a catastrophic scenario where there's a huge deceleration and the property market bubble burst, etc. So that is unlikely to actually happen with the recent cuts in the reserve requirement ratio and also the fall in the loan prime rate. So we think that China's economy is slowing, but that shouldn't be spilling over to the rest of the world. And so I think rightly so, investors are probably right to be relatively sanguine at this moment.
Jen, thank you so much. Janet Muir, investment director at Brewin, Dolphin, joining us on some of the bold calls for 2022. Also, in the meantime, let's check what Tesla is doing pre-market, gaining some 1.3%. This is after Elon Musk actually sold more shares in Tesla, meaning he's now more than 3/4 of the way to making good on his pledge to sell 10% of his stake in the electric car maker, getting some 1.4% for Tesla in pre-market. Now let's get straight to the Bloomberg First Word News. Here's Leanne Garrett. Hi, Leanne.
Good morning, Francine. UK Prime Minister Boris Johnson has ruled out stricter COVID rules before Christmas. He's drawing a line under speculation people may have to rethink their festive plans for a second year in a row. But he did warn that the government may impose more curbs after December the 25th. The UK is also now saying people who have tested positive will only have to self-isolate for 7 days rather than the original 10. Now, President Joe Biden says there will be a chance he can strike a deal on Build Back Better with Senator Joe Manchin. The president addressed the future of his flagship $2 trillion economic plan for the first time since the West Virginia Democrat rejected those measures. The president again described the legislation as a tool to combat rising inflation. And Novavax expects data on the efficacy of its vaccine against Omicron within days. CEO Stanley Erck told Bloomberg the firm is working to determine how well its vaccine works. It is based on older technology than the messenger RNA vaccines. Novavax vaccine got clearance from European regulators earlier this week.
We're evaluating the serum from people who've already been vaccinated and looking at the Omicron responses, the antibody responses to Omicron. We'll have those data within days. And so our expectation, based upon what we saw with Alpha, Beta, and Delta, is that we'll have a robust protective level of antibodies with Omicron, just as we have with the others.
Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg. Francine, lovely to have you back.
Oh, Leanne, it's so lovely to be back. And 3 sleeps until Christmas. Coming up, European energy prices hit fresh records as Europe struggles to keep the lights on. We discuss that next. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, we're just listening to President Erdogan of Turkey after that unusual monetary policy. It's probably the most diplomatic way of putting it. He has been speaking in Ankara. I think yesterday he's again speaking in Ankara. We've had wild swings and wild gyrations. I have to say, our head of charts has had a lot of fun looking at what has been happening over the last couple of days and weeks. And currently, Turkish lira 12.5 against the dollar. Now, energy prices are continuing to soar. Prices surged more than 20% yesterday to fresh records after Russia curbed gas flows to Europe. Let's get straight to our reporter who's been covering this from the very beginning, Isis Almeida, who leads our gas, power, and renewables team in Europe. Isis, great to have you on the program today. So what exactly is behind the surge?
Thanks, Francine. We basically had a combination of the winter that's just started. It's got cold. You know, we had negative temperatures in several European capitals this week. We have nuclear outages in France, so a lot of the French nukes are actually out. And on top of that, Russia actually has limited flows. We had no flows through the Europe pipeline into Germany yesterday, and instead the pipeline was reversed. So basically, gas was flowing from Germany to Poland. The same is happening today, and all of that, you know, has just got to a point that, you know, combined with low volatility that you see in the holiday season, sent prices up by more than 20% yesterday.
So, Isis, when are you expecting to stabilize it? And again, is there anything, you know, we blame a lot of Russia for it, but some of the gas prices that could also go to Europe, or some of the gas inventories that could go to Europe, for example, from the U.S., go to Asia because they pay more for it?
Yeah, that had been the case up to now. We had a lot of LNG cargoes that were going to Asia, but now that has started to reverse. The European gas price is trading at a rare premium to the Asian price during the winter, something that doesn't always happen. And we've actually started seeing some of the LNG tankers reverse course and come to Europe. You know, it takes some time before, you know, a tanker that was all the way near China to reverse and get here. So we are expecting more LNG to arrive in the middle of January. So that's good news. However, that's probably not enough to compensate for the shortfalls in Russia. If you look for the pipeline, if you look at what Russia has done in terms of booking pipeline capacity to flow gas in January, the signals are there that the crunch is going to continue.
So I mean, will it take then 6 months to possibly stabilize? I don't know how difficult it is to have a view that's, quite a long way off. And I love that chart. We can do this on the Bloomberg terminal. There's a great map actually looking at some of the ways of getting, energy in and out of Europe.
Yeah, it's actually quite hard to say when it's going to stabilize, because if you look at the gas curve, so if you look at what's happening to forward contracts, some of those forward contracts are actually going up more than the front month. So the spot prices are going up 20%, but the forwards are going up 30 to 40%. So the sign is there that the crunch is going to continue. Yesterday, the summer price traded above 100 euros, increasing some 30% yesterday. So it's actually telling us, look, this is going to continue, and it's going to be expensive even when it's hot.
Isis, thank you so much. Isis Almeida there with the very latest on energy. This is Bloomberg. So Joe Biden says Omicron will result in more breakthrough infections amongst the vaccinated and that a winter of severe illness and death even awaits the unvaccinated. Boris Johnson rules out more curbs before Christmas but warns new restrictions are possible afterwards. England cuts its COVID isolation period from 10 to 7 days. Plus, Europe's energy crunch deepens. Prices soar to fresh records, threatening to derail the continent's economic recovery. So good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, let's do an extensive market check just because there's something going on when it comes to Treasury yields. Of course, this is probably the big one to watch out for as we enter into 2022. The other stories, of course, is the Turkish central bank. I have to say that we have some great news stories on the Bloomberg terminal, including one entitled Erdogan's move comes too late to save 2021 for Turkish debt. If we look at Turkish lira volatility, definitely jumping to a record after the rescue plan, currently 12.61. Amongst the industry groups that are losing the most, we have basic resources, down 0.3%, and the S&P futures also down 0.2%. The market's a little bit looking for direction. I think partly it's because we don't have a lot of earnings, certainly not in Europe, partly also because it's thin trading volumes. A lot of people are off 3 days before Christmas. So let's also look at what Turkey's doing with President Erdogan speaking live at the moment in Ankara, and let's talk more about Turkey on this with Simon Quijano-Evans. He's Chief Economist at GemCorp Capital and EM Asset Manager. Thank you so much, Simon, for joining us. I have to say, volatility in the Turkish lira soared yesterday, the government introducing emergency measures to bolster the currency. I mean, is it just impossible to trade at the moment because you don't know what comes next?
As you say, I mean, with this sort of volatility, it's not only impossible to trade or to hold, it's also very difficult for local retail investors or depositors to know exactly what's going on. And the second thing is obviously, given what we've seen and heard in the last several years, it's also very difficult to analyze properly and to be able to gain a real view of what's going on. So I think these are the things that obviously cause the volatility. And finally, let's face it, Turkey.
Go ahead, Simon.
Let's face it, I mean, Turkey is a capitalist economy, and we all love Turkey. I mean, everybody wants to be visiting Turkey. People want to invest in Turkey. It's not that anyone wants to damage anything in Turkey. And I think that this perception is something that needs to come together, both from the leadership side and in the international investment community side.
Yeah, I mean, if you see, what happened over the last couple of days, the lira literally whipsawed between gains and losses after surging as much as 20% against the US dollar. So what does the lira become from now on?
So let's face it, the lira is the most important currency for Turks who are living in Turkey. And the thing here is that that's the main thing that the leadership needs to take into account. The rest of the world doesn't matter. And also, if you look at real interest rates everywhere else in this world, places like Brazil, Russia, Mexico, oil exporters who have actually a positive basic balance, so current account plus FDI, these guys all have positive forward-looking real interest rates. So the competition from abroad is also high, which means that international capital markets will be looking to push to put in place investments in those currencies rather than those currencies where you see negative real interest rates. So that's the bottom line. It's very simple. And you know, the marginal amount needed to move the lira at any stage at the moment is very small, given that we saw that the liquidity just dried up.
But Simon, is this an idiosyncratic problem for Turkey, or actually because they're competing for international capital, it just makes it much harder?
Yes, it makes it that much harder, as you say. You see, I mean, it's not. We've all been faced with this in Turkey in the last several years. So those were the idiosyncrasies. But now, with the Fed tightening monetary policy and others, as I mentioned, you know, having high real interest rates, there's a lot of competition out there. So it's not just a Turkey-related issue. Turkey needs to look at what's going on in the rest of the world now, too.
So talk to me a little bit about maybe some of the oil exporting countries. I'm thinking of Russia, Mexico, and Brazil. Is 2022 going to be their year?
That's a very good question. I think for local currency assets in emerging markets, we've seen real big underperformance. And the main reason, as you've mentioned many times, is the stronger dollar. And this is something we're going to be faced with in 2022, a stronger dollar backdrop as we go into the new year, and the Fed tightening, and maybe even tightening anymore, much more as they see inflation picking up. So I think that's going to be the biggest challenge. The interesting ones are the dollar bonds out there in emerging markets, and you know, we're looking at places like maybe even Turkey or sub-Saharan Africa. So I think there's really quite a mix there. And investors in emerging market assets are really going to distinguish between local currency assets and dollar assets.
Yeah. I mean, we had a pretty interesting turning point in politics in Chile. What does it mean for investors?
I think Chile is an interesting point because the Chilean peso has been actually second to Turkish lira, the underperformer in emerging markets this year. A lot of local politics, a lot of volatility on copper prices. You've had the elections just recently, as you know, with a left of center person being elected as president quite strongly. So I think the interesting thing to see LATAM in general in 2022, because it's been a big underperformer if you look at the MB Global Diversified, so the dollar bonds. I think that Chile is an interesting experiment as we go ahead to try to find some midway, if you like, a balance between far right and far left. And this is something that Latin America in general needs.
So when you look in general at some of the emerging markets, is there a part of the world that you like more than others, especially, you know, as you beautifully laid it out, the difference between, you know, local currency assets and hard currency assets?
If we're looking at hard currency assets, I love Africa, and it's particularly sub-Saharan Africa. I mean, there's so much potential there. If we look back in 2021-20, the region received such a small amount of vaccines, and nonetheless, they dealt with it. We've seen this Omicron being discovered in South Africa because they have the sequencing potential to do that. But the one problem that sub-Saharan Africa has is low vaccines. Vaccine rate of about fully vaccinated about 8% of the population. And this has to change. The global community needs to address this, not only for sub-Saharan Africa, but for the rest of the world. Everybody needs to get vaccinated to bring down this pandemic and to sort it out once and for all.
Simon, give me a sense of, you know, we talk a lot about foreign affairs and we talk a lot about the possibility of Russia continuing, if not, you know, scaremongering or even going as far as invading certain parts of Ukraine. What does that mean for emerging market investors in that part of the world?
I think that's a good point, you know, and this is something that EM investors have been focusing on for many years. And actually, Central and Eastern Europe, whether you look at Turkey, Russia, Ukraine, has been on the minds of everybody for a long time. Geopolitical aspects play a major part here. Let's hope that there is no major escalation now during the Christmas days, the next few weeks, whether it's Christmas in Western Europe or the Christmas celebrations in Eastern Europe. What we need to see is a convergence of politics, as you mentioned, between the European Union and Russia. And maybe the talks that Mr. Biden is having with Mr. Putin will reap some positive benefits. And I think there's a potential for breakthrough there.
Great. Thank you so much, Simon Cristiano-Evans, there, Chief Economist at GemCorp Capital, joining us to talk about emerging markets. Now, coming up, nearly 1 year after Brexit, how's the British economy faring? We take stock next. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, the chief executive of AstraZeneca has played a vital role in tackling the biggest health crisis of our time. Pascal Soriot has overseen the production of one of the leading vaccines against COVID-19 with over 2 billion doses produced globally. But it was a rocky road to begin with to bring the shot to the market. Well, we sat down to discuss the successes and challenges AstraZeneca faced along the way from their very first conversation with Oxford University.
The first phone call was really a great phone call because, we were thinking, how do we help? And we thought, we have potential treatments. We have a long-acting antibody combination in development. A vaccine would be the next step. And this looks like a great technology. And, many people at AZ have connections with Oxford University. And we know a number of people there. So the first contact by telephone was, of course, an easy one because we knew each other. And in terms of the results, it was, of course, very energizing. We were so happy to have a vaccine that works and can make a difference globally. But we never really had much time to think and celebrate. We did celebrate a little bit, but essentially we were go, go, go because time was of the essence to get approval, to manufacture. And as you know, we had a few challenges in some geographies. In some geographies in the world, it went very well, and in other countries, it was more challenging to supply. So we didn't have much time to think and celebrate. We were focused on delivering and making sure people could get access to our vaccine.
Yeah, and I imagine between the go, go, go and, of course, being in the middle of a political firestorm in certain cases as well, was quite challenging. What was the most infuriating or frustrating part of the process?
Well, nothing was infuriating. In our industry, we're used to challenges. I mean, you tackle a big problem like cancer, and you try to develop new treatments. And sometimes you succeed, sometimes you fail. And sometimes some of those failures are, of course, large ones and very disappointing. So we are used to dealing with challenges and success and setbacks and sometimes criticisms. And, it's part of life, really. So we had to take it on the chin and deal with it and try our best. And our focus was really on, again, delivering the vaccine to the world. And, I think people sometimes forget that Europe, of course, is a very important continent. Look, I'm a European, I love Europe. But Europe, not everybody in the world lives in Europe. I mean, there's another more than 7 billion people living outside the US and Europe. And in many, many parts of the world, in most parts of the world, everything went well. So when we were looking at it on a global basis, we realized we had to help Europe more than to deliver more vaccine. But we also knew that elsewhere in the world, everything was going very well.
Pascal, was there anything that you would do differently with hindsight, the benefit of hindsight, in Europe? And do you feel like you were unfairly politicized at moments?
I think sometimes people try to read too much with hindsight. I mean, it's like running a clinical trial. If the trial fails, people will ask you, would you do this trial again? I mean, if you know it fails, of course you will not run it again. But this is hindsight. I mean, so there's nothing really that we would do differently. Politics was always going to be part of this issue. It probably was more than we had anticipated, but it was always going to be part of this issue because we expected issues of moving vaccines around the world. We expected export bans. We expected debate around the value of vaccines. So we expected a lot of political issues and debates. It was more than, in Europe, it was more than expected, of course. But we, stayed totally focused on delivering the vaccine and solving the problems as they came.
AstraZeneca's chief executive there, Pascal Soriot, developing the pharma giant's COVID vaccine. And you can catch more of our conversation on the next episode of Leaders with Lacqua. It airs this week, Thursday night, 7:30 p.m. London time. Now let's get back to your Bloomberg Business Flash with Leanne Gerrans. Hi, Leanne.
Hi, Francine. We have just seen the biggest ever loan of its kind in the private credit market. Sources tell Bloomberg that Apollo is planning to lend about $4 billion to SoftBank. The financing will be backed by holdings of Vision Fund 2, which is valued at about $40 billion. We are told the terms are not yet final and both sides of the deal are declining to comment. Now, Wells Fargo has postponed its return to office plans indefinitely. It comes amid the worldwide surge in COVID cases linked to Omicron. According to a statement, employees will be briefed on the bank's plans in 2022. It had originally postponed a November the 1st return date to January the 20th. Rio Tinto has agreed to buy a lithium mine in Argentina for $825 million. It comes as the world's second biggest miner accelerates its push into battery materials. The firm is looking to expand in the field of so-called future-facing commodities. That includes lithium, copper, and even fertilizers. And the company with the biggest market cap now also has the biggest credit score. Apple's long-term rating was upgraded to AAA by Moody's. That puts it in an exclusive club with Microsoft and Johnson & Johnson as the only firms in the S&P 500 with the highest possible score. And that's your Bloomberg Business Flash. Francine.
If only our credit rating, Leanne, would be so high. Maybe something to aspire for in 2022. Now, it's been almost a year since the UK technically severed ties with the European Union, so it's time for a report card on how Britain has actually fared in its first year of going it alone. Well, we're now joined by Bloomberg's UK economy reporter, Lizzie Burden. Lizzie, great to have you here and to take stock a year on from, of course, Brexit. So is it too early to separate the effects of Brexit and COVID-19?
It's actually been really difficult to disentangle the two, but what you can see over the past 12 months is that UK trade with the EU has declined compared to UK trade with the rest of the world. And really interesting analysis from the Centre for European Reform shows that if you compare what the UK's trade with the EU would have been had we stayed in the bloc with what it was over the past 10 months, there's a 15% gap, so not insignificant, and it's set to get worse from January when you get even more checks on EU goods coming to the UK. And you've got Liz Truss, the Foreign Secretary, taking over from Brexit Minister David Frost. She's not likely to be a soft touch on Brexit. She's already said she could trigger Article 16 of the Northern Ireland Protocol. That could tank the Brexit trade agreement and make 2022 even rockier for UK-EU trade.
Yeah, it's always quite uncertain when you have someone else in charge, someone new that you're trying to get used to in terms of language and tone. Third quarter GDP, what do those figures look like?
Well, it was revised down from the previous estimate, and what it means for the economy is we won't likely get back to pre-pandemic levels until mid-2022. The US is already there, but the Brexit impact on the economy is likely to be 4% over the long term. That's according to the UK's fiscal watchdog.
All right, Lizzie, thank you so much. Our Lizzie Burden there with the very latest look on what's happened to the UK economy over the last 12 months. Now, you can also read more on how Brexit in 1 year has hit the UK economy and business. That's on your terminal and on Bloomberg.com. We're also looking at live pictures of the president of the Council of Italy, Mario Draghi, actually holding his year-end press conference. I think The Economist just voted Italy as the country to watch out for in 2022. So we'll have plenty more on what that means for investors. Coming up, the biggest U.S. banks are making more money than ever. So why are finance veterans feeling unsettled? We've got the big take next. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, time for the Bloomberg Big Take. And the major U.S. banks are making more money than ever with record bonuses to match. But there's also a feeling that success in traditional Wall Street is being overshadowed by the riches pouring out of tech, crypto, and whatever Elon Musk is doing. In short, being a master of finance no longer means being a master of the universe. Well, Bloomberg's Tom Metcalf is here to discuss all of this, although he himself is still a master of the world. Tom, why this anxiousness and angst amongst bankers?
Yeah, it's a fascinating look, this story, about kind of the psychology behind this, because perhaps as an outsider, you'd look at a banker raking in, sometimes millions in bonuses and wonder, what's wrong with that? But I think it's three things that Max Abelson, our colleague, pulls out. One is just what a crazy year it is just generally for, with the pandemic for the last couple of years. Basically, people are reassessing everything. 2 is just how hard bankers are working. And, yes, they're getting these big bonuses, but they're probably looking around at folk in, like you say, tech, crypto, and saying, hey, we are sort of working more than these folk and actually getting paid less. And then again, on that sort of level of hard work, it's just been a brutal last 12 months. A record year means sort of record hours, and I think there's quite a lot of burnout as well.
So, Tom, I guess $1 million question is we're seeing quite a lot of, extra bonuses and at record highs in terms of payment for bankers. Is this because of the record year in terms of revenue, or is it really because they're worried about losing up, employees, for example, to the tech sector?
Yeah, no, executives have been telling our reporters it's a bit of a mix of both. So, yes, performance has been really, really good, but they're very worried about losing, particularly that top talent to sectors like tech, to crypto firms, to private equity houses as well. So, that's partly why we're seeing these really big numbers mooted for these bonus pools, because there is genuinely a worry among sort of the executive floors at banks that, they might see a big exodus.
So will they cheer up in 2022?
Well, certainly they hope that that kind of big bonus that's expected to get paid out from February really will help. I mean, in terms of directionally, the industry is firing on all cylinders really in terms of deal levels, activity, and that's probably set to continue. So it'll be another busy year, but whether that makes the bankers happy is another question.
Okay, I know you'll continue tracking all of that throughout the new year. So, Tom, thank you so much to you and team for some really great reporting, great scoops through 2021. Now, you can read more on that story. Just go on to NI Big Take on your Bloomberg terminal. In the meantime, we're also listening to Mario Draghi saying that the government is ready to act if there was a resurgence of, government crises because of Omicron. Now, the government needs a broad majority like the current one. He's also saying that Italy has fulfilled all of its commitments for the EU recovery funds. Again, Premier Mario Draghi talking there in Rome for his final press conference of the year, reminding everyone that the government is ready to support the economy if it slows down because of the new variant. This is what the markets are doing. Stocks seem to be pretty much steady. They're kind of directionless after the volatility and certainly the wild swings that we saw yesterday and the day before. We've seen a rebound in stocks, moderating today. U.S. futures actually drifting lower amid uncertainty of Omicron strain's impact on the economy and the foggy outlook for U.S. fiscal stimulus. I know we need to talk a lot more about Joe Manchin. A lot of economists are telling us there is a way through for this to happen. Now, markets have been pretty volatile at the end of a year that has seen equity rallies, for example, amid a recovery from the pandemic before losing some steam on worries about inflation, tighter policy, and the Omicron virus variant, which is prompting tighter curbs. So we're looking at Italy with Mario Draghi giving that press conference. Another head of state giving a press conference is President Erdogan of Turkey. Wow, the Turkish lira certainly had some wild ride over the last couple of days. In fact, volatility in the Turkish lira soared yesterday after the government introduced emergency measures to bolster the currency. So I think President Erdogan is going through some of those measures now. Bloomberg Surveillance Early Edition continues in the next hour. Matt Miller will be in Berlin, Kailey Leinz in New York, Anna Edwards here in London. This is Bloomberg.
We should all be concerned about Omicron, but not panicked.
We are taking Omicron very seriously, as you would expect us to. But at the same time, we are confident that we'll be able to continue to ensure we can face down the most recent challenge.
We don't think today that there is enough evidence to justify any tougher measures before Christmas.
This is Bloomberg Surveillance, Early Edition, with Anna Edwards, Matt Miller, and Kailey Leinz.
It is 10 a.m. in London, 5 a.m. in New York, and 6 p.m. in Hong Kong on this Wednesday, December the 22nd. Our top stories today. Boris Johnson rules out stricter pandemic rules, but urges caution, while Joe Biden warns the Omicron variant will result in more breakthrough infections. And Biden is keeping hope alive that he can reach a deal with Senator Joe Manchin to get his economic plan through Congress. Plus, Elon Musk sells more Tesla shares. The billionaire inches closer to his pledge to sell 10% of his stake in the electric car maker. Welcome to Bloomberg Surveillance Early Edition. I'm Anna Edwards with Danny Berger in London and Kailey Leinz in New York. Matt Miller is off this week. And Kailey, I am exhausted, frankly, after 2 days watching these markets whipsaw from heavy selling on Monday to the buying of yesterday. Things a little calmer this morning.
Yeah, good news for you, Anna. It doesn't seem as noisy out there. Granted, it is a holiday week, so we know volume was a little bit light, and as a result, movement's a little bit light today as well. You really saw some of that rebound losing steam in Asia overnight. Yes, the MSCI Asia Pacific's index was higher, but only by about 0.3%, so no major moves. And one area of underperformance within Asia was actually in Chinese property stocks. These rose big time yesterday after a local government had posted something online pledging support for the real estate sector, and then that post was taken down, creating some confusion, and as a result, investors actually selling property stocks today. That Shanghai property index down about 1 percentage point. I would point out as well that in Thailand, you actually have one of the big underperformers when it comes to currencies in Asia. The Thai baht weaker against the dollar by about 0.2%. The central bank cutting its growth outlook for 2022, saying it expects the Omicron variant to have an impact in the early part of the year. And the same worries about the Omicron variant leading traders to dial back some of their their RBA hike expectations. And as a result, you are seeing in the belly of the curve in Australia, yields coming down about 6 basis points overnight. Now, as for the picture here in the U.S., it also is really relatively quiet. Right now, S&P 500 futures are down, but only by about 0.2%. Not much action in the bond market either. We do move up a little more than a basis point on the 10-year Treasury yield to 148, still remaining sub 150. You are seeing a continued rebound in crude, however, up about 0.5%. WTI trading at $71.50 a barrel. And then Bitcoin also not moving much, Danny, but you can basically expect if futures are lower, Bitcoin will be lower, and that's basically the case today, down about 0.4% to just below that $49,000 level.
Definitely feels like that run up to the holidays lull finally happening today. That is the case for Europe as well. We're looking at stocks attempting to post a second day of gains, though volumes are off by about 50% of their 20-day average. We're looking at gains of basically 0.1% for both the DAX and the CAC 40. Losses you're seeing both in the FTSE MIB and the UK index. A lot of that has to do with the fact that value just is underperforming today. So things like materials, where that has a very heavy presence in the UK, as well as financials, Italian banks underperforming as well. But if we look into some of the other asset classes today, we'll see some more interesting stories. I first want to focus, though, on natural gas. Yesterday, hitting record after record. It is starting to come down. This is Dutch front-month futures down 3%. It is this supply crunch in Europe. It's taking a breather, but down only 3%, so barely moving from the all-time highs where you see gains that push beyond 10%. So this is a relatively calm day given all of that. Now, checking out some of the other currencies, despite the fact that we're looking at a wishy-washy sort of day in stocks, you're not having any bid for safe havens when it comes to currencies. The Swissy slightly lower but unchanged versus the dollar. A generally stronger dollar today, which is also meaning the euro is falling. We're seeing a lot of demand for U.S. assets, for U.S. Treasuries. Saw that in the auction yesterday. And finally, the lira, weaker by 0.6%, but it's been up as much as 1% today, 2% down as much as 1%. So the volatility, still no end there for the lira, Anna.
Yeah, I know we're supposed to embrace all of this volatility, Danny, but this close to the end of the year, it is a bit exhausting. Let's have a look at what else lies ahead for us today then. The EU is likely to unveil its plan for how natural gas and nuclear energy projects would be classified under its green investment rules, and different countries rely differently on these technologies, so it'd be really interesting to see who leads on these. We'll get the EIA crude oil inventory report. That's at 10:30 a.m. New York time. That will be really timely as the Omicron variant spread threatens the demand picture. We'll get some US data as well today, including consumer confidence and mortgage applications. And crucially, the US Food and Drug Administration is poised to authorize a pair of pills from Pfizer and Merck to treat COVID-19, Kailey, and that's really topical right now, just this morning.
Yeah, we actually had some breaking news on it just moments ago on the topic of COVID treatments, Anna. From the White House, the Biden administration expects to take delivery of 4 million courses of COVID-19 treatments by the end of January. That will help doctors fight severe coronavirus as the U.S. faces another surge in cases driven by Omicron. Let's get more on this with Rachel Chang, a healthcare editor for Bloomberg News. Rachel, it seems now the focus is not so much on stopping the spread of the virus through restrictions, more so on treating it and vaccinating against it so that people don't get as sick. Is that a right characterization?
Yeah, absolutely. I think, for most major Western economies, the US, the UK, it's very much a case where the horse is out of the barn, or however you say it, right? I mean, I think we're not going to be able to stop the spread of infection. More importantly, people don't want to really go back to the lockdowns and the types of curbs that you need. People want to see their family and friends for Christmas and enjoy the holidays. So the question really now is, can we vaccinate? Can we get those booster shots out to protect people? At the same time, the FDA is moving very quickly on these COVID pills, which do have the effect of preventing infection from escalating to hospitalization and severity. And so that's the thing that people feel is going to help these countries to stay to the new normal.
Yeah, it's really interesting. Good morning to you, Rachel. Really interesting that we've seen just in the last few minutes, as Kailey says, this announcement from the Biden administration, around 4 million or so antivirals in January. And just before that, hours before, we saw the UK ordering 4.25 million antivirals to help in the Omicron variant fight here. And to Kailey's point, maybe this does tell us about certainly how these two geographies are going to fight this round of COVID-19. What more do we know about the severity of the Omicron variant, Rachel? Because there's been some reporting here in the UK that, a lot of people are asking whether it is going to be deemed to be less deadly, whether it's going to be a milder virus. Have we got any further news on that yet?
The science is still not conclusive, but I think that the anecdotal evidence is very much leaning in that direction. And the evidence that was coming out from South Africa was very much in that direction as well, where we saw cases really peak quite quickly without hospitalizations and deaths reaching the same level at all. But, South Africa is a very different place from the Western countries we're talking about. The demography is very different. So the key question really now is in the US and the UK. We see this infection just spike so quickly. We know that Omicron is so much more contagious than Delta. And so if that hospitalization and fatality line doesn't budge at all, then I think that's the evidence we need to know that it's much milder. Anecdotally, we're hearing a lot of people, especially with booster shots, they are infected, they're positive on the test, but they don't see any symptoms at all. A lot of them are completely asymptomatic. So that's really positive news as well.
All right, thank you so much to Bloomberg's Rachel Chang with the latest on the virus. And of course, that's not the only thing that President Biden is thinking about right now. He also has to focus on that fiscal spending package. And he said yesterday there is still a path forward for his economic plan, despite the opposition from Senator Joe Manchin. Let's get to Anne-Marie Horton, Bloomberg Washington correspondent, who joins us now from D.C. Anne-Marie, the president optimistic. We understand that Chuck Schumer also convened a call with Senate Democrats yesterday, in part to discuss Build Back Better, and that Joe Manchin took part. Has there been any real progress in the last couple of days, or is the president just expressing his hopes and dreams?
I think the progress is just that they're all kind of walking away, tiptoeing away from the brink of there can never be a deal. The president yesterday was asked about this after he gave a lengthy speech on COVID. Of course, the reporters wanted to know, what about your landmark legislation that was dead in the water, what it seemed like Sunday morning? And what he said is that Senator Manchin and I will get something done. He does think that this can still be salvageable. And as you mentioned, Senator Schumer had a call last night. Senator Manchin was on that call, and they discussed the paths forward for January. What Senator Schumer wants is a revised legislation, Build Back Better, potentially something that is just more in line with Senator Manchin could get on board from. But the key question is, even if the president can salvage this deal with Senator Manchin, what happens to the 49 other Democrats? Are some of their priorities going to be taken off the table to meet Senator Manchin's? It's going to be very, very tricky. And that's been the entire game for this president this entire time. It is very hard to get every single member of his party. He needs every single 50 Democrats to vote yes on this legislation.
Okay, he says he'll still get something done. We'll see. Bloomberg's Anne-Marie Horton, thanks very much for the update in Washington. Now, Elon Musk is now more than 3/4 of the way to making good on his pledge to sell 10% of his stake in Tesla. Bloomberg's Laura Wright has the latest on Musk's pledge. Laura.
Well, yeah, you're right. He sold 13.5 million shares. He needs to sell 17 million shares to reach that 10% goal. The catalyst was that contentious Twitter poll back in November, when Musk was seemingly conscious that unrealized gains were seen as a means of tax avoidance. Just a few days ago, we learned that Musk is ostensibly going to pay $11 billion in taxation this year.
And when we talk about Tesla's performance, Laura, of course, it has now been about a year since it joined the S&P 500. A lot of people thought that may mean less volatility, but this stock has moved something like 4 times the degree to which the broader index moves on a daily basis.
Yeah, extreme volatility for Tesla. There has been broad volatility in the markets, a few catalysts for Tesla. But look, year to date, the stock is up 33%, an outperformance on the S&P 500 benchmark, still sky-high valuation, trading at 109 times forward earnings. The market is trying to work out what is the future for Tesla and other EV makers, and it's been a fast-changing environment. At the beginning of the year, NIO, Tesla's Chinese competitor, launched a luxury sedan that led Tesla to fall to the downside. In October, Hertz announced they were going to purchase 100,000 Teslas, which led the stock to move to the upside. But we cannot talk about Tesla without talking about Elon Musk's personality, his eccentricity that leads this retail trading crowd to adore him.
Yeah, and we can't talk about it without talking about Elon Musk's musings on Twitter either. Thank you so much to Bloomberg's Laura Wright. And while we're talking about individual equities, let's take a look at some stocks moving in pre-market trading here in the U.S. One moving to the downside is Biogen, and this is after Japan's health ministry panel said it cannot yet approve the Alzheimer's drug that Biogen has developed, Aduhelm, because it doesn't actually have efficacy data that justifies approval. So right now that stock is down about 2%. Elsewhere in biopharma, I would talk about Merck because, of course, we were discussing the administration's plans on COVID-19 treatments next month, and we are expecting the FDA could approve the COVID pills from Merck as well as Pfizer this week, possibly as early as today. So that stock up a bit in pre-market trading by about 0.7%. And one other stock I wanted to mention is Alibaba. Those ADRs here in the U.S. down about 3.7% after you saw some weakness developing in tech in Asia overnight, and that is after news that Alibaba's cloud unit and a cooperation with government has ended due to a security breach that Alibaba didn't warn about in time, so that is taking shares down of Alibaba and other Chinese tech ADRs as well, Danny.
Well, the whipsaw of the market applying to some of those individual stocks as well. And coming up, we'll discuss that whipsaw and the market response to Omicron with Matt Maley, Chief Market Strategist at Miller Tabak, and Europe's energy crisis. We'll speak with ABN AMRO Senior Energy Economist Hans van Cleef. Plus, Wall Street's existential angst, how the biggest U.S. banks are assessing the end to a wild year. This is Bloomberg. Welcome back to Bloomberg Surveillance Early Edition. Now, we're getting a rare reprieve today of the whipsaw in markets we've experienced over the last few days. And Anna, I'm sorry, I know you were enjoying that reprieve today, but I'm going to go ahead and focus back in on the volatility we've seen in equity markets. For the benefit of our radio audience, I have a chart up here that looks at the average absolute move in the S&P 500 broken down by month. For this year, so far, December by far has been the most volatile period with those absolute moves over 1%. But if we look historically, this is really a rare circumstance. If we look at data back from 1953, and this is data from Bespoke Investment, typically, December is the least volatile month out of any of them. And yes, we have seen some volatility in prior Decembers in the years past, but really, on a long-term basis, this usually is a time where people can move away from their desks, not pay attention, and just spend time with family. But perhaps that's not the case this year. Let's bring in Christine Aquino, who helps lead Bloomberg's market coverage for us. Christine, how should we be thinking about this month's extreme volatility?
Well, Danny, we are sitting at a very, very unique time in terms of market history, right? I mean, we're looking at basically standing at the precipice of a really major sea change in monetary policy. We have a bunch of major central banks, including the Federal Reserve and the Bank of England, heading toward that policy normalization and that process of starting to remove this really unprecedented level of monetary policy support that we've enjoyed over the past decade. And then at the same time, we're also being confronted with a new coronavirus strain in the form of Omicron, and all the risks of that bringing light to investors' radar from the potential of, again, a renewed series of lockdowns across a number of different countries and potential shortages in workers, such as what we're seeing in the UK. All these kind of coming together, really making for a case that this December is quite unique compared to other points in time.
Yeah, incredible to see that, Chan, just how much volatility we have seen in stocks. We've also seen it in bonds, Christine, but not so much in FX. What's going on? Why has this not translated into FX volatility?
That is the big puzzle for us, Anna, for sure. And I think it really boils down to a little bit of questions over how all of this changes in policy, how the potential for Omicron to wreak havoc in the economy, how that plays into the FX markets. I mean, for instance, the dollar has been one of the biggest surprises this year. There was broad expectation for it to weaken over 2021, over expectations for economies to start reopening and that safe haven bid going away. Of course, we've not seen that. We've seen the complete opposite of that, because in some ways, the dollar has been seen as very much still the haven asset that it has been over the last few years, but also it's been seen as a play on the U.S. economy and how it is potentially positioned for gains if the U.S. economy does in fact run away from the rest of the world and carry on with its improvement and gains there. But then, of course, with questions over President Biden's economic plan coming into fore now, then that's very much still up in the air. And so I think that's why we're seeing less volatility in the space, because there's so many questions around how to trade this in the FX space.
There's just a lot of questions in general, Christine, and a lot of uncertainties and risks that people may want to hedge against. What is showing up as the hedge right now? Because it's not necessarily your traditional havens.
Not at all, Kailey, and I think it is very much dependent on your core views heading into 2022, right? I think, anyone who's inclined, for instance, to think that tech stocks are still very much a good hedge against inflation, for instance, or the belief that maybe yields aren't going to be skyrocketing as much as perhaps some investors are expecting. There's very much still a belief in that sector. But then, of course, when you're talking about some of your more risk-averse institutional funds and pension funds, for instance, still very much big buyers of that 60-40 strategy and believing that bonds, again, are still very much good value, especially if we're expecting an environment of higher yields going into 2022. Maybe they're going to get a little bit more bang for the buck from that space next year.
Christine, thanks very much. Thanks for the analysis. Bloomberg's Christine Aquino joining us there from the Markets Live team. And of course, you can get market analysis from the Markets Live team. MLIV Go is the function to use on your terminal to get their thoughts. This is Bloomberg. This is Bloomberg Surveillance Early Edition. I'm Anna Edwards with Danny Berger in London and Kailey Leinz in New York. And now let's get your first word news. The annual meeting of the World Economic Forum, which was postponed to summer 2022, is set to take place in Davos, Switzerland. Founder Klaus Schwab tells the Swiss newspaper Blick he consulted with a panel of virologists about delaying the event, which was scheduled for next month. The decision was based on COVID-19 infection rates, the new Omicron variant, and countries such as the United States advising against traveling to Switzerland. Apollo Global Management is planning to lend about $4 billion to SoftBank. Bloomberg has learned the financing will be backed by holdings of Vision Fund 2. It would be the biggest ever loan of its kind in the private credit market. Masayoshi Son's investment powerhouse has been grappling with a spate of high-profile departures, as well as a cratering of value in holdings. And Wells Fargo has postponed its return to office plans indefinitely. It comes amid the worldwide surge in COVID cases linked to Omicron. According to a statement, employees will be briefed on the bank's plans in 2022. It had originally postponed a November 1st return date to January 20th. So, Kailey, these dates, they get pushed back. Really interesting piece by Tyler Cohen from Bloomberg Opinion on the Bloomberg, talking about how, yes, individually, we may feel like we're all ready to move on a little bit, but institutions will find that very difficult without the right kind of structural, sort of infrastructural leadership from the top. All I know is I don't really want camera equipment back in my house again. That was a phase of my life I never thought I'd see, and I'm not sure I want to revisit.
Yeah, I don't want camera equipment in my house either because I feel like it's more than likely my puppy will try and chew on every single part of it, Anna. But I think this raises a really interesting question. If you're running a business right now, even if your employees are vaccinated and boosted and you know that they won't get seriously sick, there's still quarantine guidance that you have to quarantine for 10 days. That can be disruptive for business even if people aren't getting extremely ill, and that's something that has to be taken into consideration.
Yeah, it really is all about, at this point, flexibility being the name of the game for Wells Fargo and other industries as well. Well, coming up, we're going to chat with Matt Maley, Miller Tabak Chief Market Strategist, as we look at a more calm equity market today. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Anna Edwards with Danny Berger in London and Kailey Leinz in New York. Matt Miller is off this week. And Danny, when we look at these markets, the Stock 600 flat this morning, up around 0.1%, which frankly makes a real break from the last couple of days. We've seen a lot of volatility, but US futures look weaker. Interesting when you look at where the sectors are, though, that we've got utilities to the downside. That's the worst performer and by quite some margin. But travel and leisure to the upside, despite the fact that with Omicron seems to come a lot more concern about whether people's travel plans remain intact.
Right, it does feel a bit of a confusing market today. Maybe we can just chalk it up to, okay, volumes are low, but there have been a lot of travel stories, a lot of airline stories that would make you think you don't want to buy this on a day like today. Bloomberg reporting that it's twice as likely to catch Omicron on planes, as we've been discussing. Singapore looking at revoking their vaccine passport ability to book planes that way. And Cathay also saying we're going to have less bookings in January. We still don't see that light at the end of the tunnel for the industry.
Right, yeah, twice as likely to get Omicron on a plane versus Delta, we should say. Yeah, that was the sort of base case they were comparing it to. That actually coming through from the industry themselves. Kailey, let me ask you then about US futures pointing to the downside, and NASDAQ futures in particular. But I mean, we saw a big rally on the NASDAQ yesterday.
Yeah, we saw outsized moves on Monday and Tuesday, so today's action, even if it is to the downside, seems pretty unremarkable by comparison, Anna. We are pointing lower with about 4 hours to go until the opening bell, but again, it's really quite mild, only down less than 0.2% on S&P 500 futures. In the bond market, no super remarkable action either. We are moving upward on the 10-year yield, but only by about 1.5 basis points. We're sitting right around that 147 level on the 10-year at the moment. The dollar giving back some earlier strength. It is now weaker for the third day in a row, but oil is trying to continue its rebound. WTI futures up about 0.5% to 71.48 a barrel. As for some stocks moving beneath the surface in pre-market trading here in the U.S., I wanted to make mention of Tesla because Elon Musk sold another $528 million worth of shares. That stock, though, is still in positive territory in pre-market trading, up about 2.3%. On the underperforming side, you have ADRs of Chinese companies, including Alibaba, which is down the better part of 4% after its cloud unit broke off a cooperation with the Chinese government. Novavax is also lower after a 12.5% loss over Monday and Tuesday. It's down about 0.7% in early hours. Yes, it has gotten approval for its COVID-19 vaccine from the EU, but doesn't yet have efficacy data against Omicron, so that may be creating some questions. And elsewhere in biopharma, Biogen's Alzheimer's drug will not get approval at this time in Japan, and as a result, it is down about 2% before the bell, Danny.
Kailey, if those are the stocks, I'm looking at the styles and what investors have been doing with their wallets as we try to navigate through this particularly turbulent period. I'm looking at a chart for those of our radio listeners that compares defensive stocks versus cyclical ones. These are MSCI indices. I'm looking at it on a weekly basis. So in the defensive camps, we have a lot of those income type stocks, those bond proxies. And last week, they outperformed the more economically sensitive ones by more than 4 percentage points. That is the highest level of outperformance since April of 2020. So investors flocking to those relatively safer stocks. Our next guest also says you should be taking a look at defensives. It's Matt Maley, Miller Tabak Chief Market Economist. Matt, great to have you on the program this morning. So why defensives?
Well, I just think with the biggest concern, we have this so much talk this week about the Omicron variant and stuff, but I still think the biggest issue we need to worry about is this change in with the global federal banks here, and we have the Fed, who's going from an incredibly emergency level of stimulus and liquidity provided into the system to pulling back on that and going to zero a lot more quickly than we had thought, and talking about raising rates, and other global central banks doing the same thing, and at least similar things in terms of pulling back. And that's going to cause people to de-risk and de-lever. We added so much risk and leverage to the marketplace when they were providing that emergency level of stimulus, even after the emergency had pretty much passed. And so I think it's the right thing to do. I mean, I noticed we've seen a lot of wild moves in the markets. And as you mentioned, these defensive groups have outperformed recently. But even on the days when the market's seen big rallies, these stocks have gone up as well. So people, even when they come in and say, geez, I want to buy these, maybe some of these tech stocks on weakness, I'm also going to spend a little bit of money on the defensive names. I think that's the right play right now.
Matt, good morning. When you think about which sectors to get involved with at this point, and you think about the cycle that we're in, how do you describe it? How do you describe where we are in the cycle? Because on some indicators, you might think we're near the start, on others, a little closer to the middle, and some would even say the end. So based on what you look at Miller Tabak, where are we in this cycle right now?
Well, that's the hardest thing to figure out, because it's so much different than it has been in any other time because of this massive liquidity that had been provided. Because usually the economy is in the mature stages of an advance when the stock market looks a little frothy here and looks like it's going to roll back over. In this case, because the Fed had shot the market up so high with their artificial stimulus, even after the emergency had passed, the economy is still relatively early in its upswing. And that's really positive on a longer term basis. So in other words, I think the market could come down next year and see some headwinds, see a correction, which we do get in most years and are normal and healthy, and really not be towards the end of that cycle. So, and therefore, in other words, it'll provide an unbelievably great opportunity to buy on weakness. But I do think we're going to face some headwinds next year, even though we're earlier in the economic cycle than we would normally be when I see the market on uneven ground.
Do you expect one of those headwinds as well to be higher Treasury yields? Because talking about how there's uncertainty about where we are in the cycle, where the health of the economy even is, the Treasury market certainly looks uncertain with the 10-year yield still south of 150.
Yeah, one of the things that's really weird that's been going on right now is everybody's concerned about higher interest rates. My bigger concern is the flattening of the yield curve, because as you mentioned, Kailey, I'm sorry, we see this big a rise in short-term rates because with the Fed, that's what they really control is short-term rates. But the long end isn't rising right now because it is a flight to safety trade, and people are worried about what's going to happen, if and when the Fed does tighten more when the Fed tightens more aggressively. So they want that safety. Not only are they buying some safety names in the stock market, but they're buying the flight to safety assets like the Treasury market. So it's interesting, though. I guess I'm less worried about interest rates long-term interest rates really shooting up than I am about the yield curve flattening because short-term rates are moving up, and that's going to be hard for especially some groups like the bank stocks, which I had been bullish on until recently.
And now what? You're underweight banks, Matt?
It's funny. I've been overweight in a big way, and kind of now back to neutral. We want to see how it plays out because I do think that once we get through the initial stages of any kind of pullback in the stock market in the first half of 2022, those long-term rates will move up a little bit, and that they'll do quite well. So I don't mean to sound like I'm talking out of both sides of my mouth, but I'm definitely more neutral now, looking to buy on weakness rather than chasing them up at these levels.
Matt, I do wonder, though, how much we can attribute this bid to duration and treasuries in general for foreign investors coming into the market, especially savers.
Well, again, it goes to this flight to safety issue. We have, when you have one thing, I guess is my concern is we're going from this emergency level of stimulus, massive stimulus, but here in the United States, the biggest economy in the world. But we also have China, who's also clamping down in a major way. They went from adding all sorts of encouraging, big adding risk adding leverage, adding debt. Now they're clamping down on all three, and every once in a while they come out and say we're going to ease off a little bit, and then within a month or so they come right back down and clamp down. So the two biggest economies in the world pulling in their horns a bit. That's got to be something that concerns investors. So both U.S. investors and foreign investors, they like that flight to safety trade, and then I think that's what's causing a lot of this movement in the bond market, in the treasury market.
All right, great insight. Thank you so much, Matt Maley. Miller Tabak, Chief Market Strategist. Thank you for waking up early for us, especially on a holiday week. Happy holidays to you and yours. I do want to bring some breaking headlines to our listeners and viewers at the moment from Mario Draghi, the Italian Prime Minister. He says that there is no need to revise down 2022 forecasts due to the Omicron variant yet. At this point. He also is mentioning the European energy crisis, saying that the increase in energy prices requires urgent action. So we will continue to monitor those headlines. And in the meantime, we will discuss further that energy crunch in Europe. Hans van Cleef, ABN AMRO senior energy economist, will be joining us next. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. You're looking live at the Principal Room. Coming up later today, Ian Bremmer, Eurasia Group President and founder. This is Bloomberg. This is Bloomberg Surveillance Early Edition. I'm Anna Edwards with Danny Berger in London and also with Kailey Leinz in New York. Now, this year's energy crunch is threatening to derail Europe's economic recovery as gas and electricity costs soar to fresh records. Prices surged more than 20% on Tuesday after Russia curbed gas flows to Europe. Joining us now is Hans van Cleef, ABN AMRO senior energy economist. Hans, very nice to speak to you. Let me get to the politics of this. How much can we tell about why gas is not flowing from Russia right now? Is this because of politics? Is this because of a really cold patch in Russia? Maybe it's because of both of those things. Or is it because European companies utilities are not asking for this gas to flow in this direction? What are the drivers that mean that gas doesn't flow from Russia to Europe?
Yeah, well, the utilities really are asking for it, so that's not the issue. Now, the problem is indeed, and it's very cold in Russia, so they say that they use a little bit more themselves, but it's highly political, of course. It seems that they are now filling up the pipeline Nord Stream 2, so the one who is going directly from Russia to Germany. And that goes a bit, as a result, we see less imports through the Yamal pipeline, which goes through Belarus and Poland. This is a really terrible situation because indeed, as you said, prices are really jumping through the roof, and the winter simply needs to begin. So it's just very early, and already we see record high prices. So it's very worrisome.
How long does this take? And this will be different in different European countries, I'm sure, Hans. But how long does it take for consumers to feel the impacts of this? Because I mean, speaking here in the UK, there are mechanisms that stop consumers from having to feel this pressure instantly. But of course, it will be coming. It will be coming when certain controls on the market are changed in the new year. What is the broad picture around Europe?
Yeah, well, all consumers will notice it. Is it not directly via their energy bill, then it's indirectly via the products, because also all kind of companies face these kind of high electricity and gas prices. It depends a little bit on what kind of contract you have. Here in the Netherlands, for instance, we have an annual contract. That's the most used one. When that's fixed for now, then we're pretty safe. But at some point in the year, it will expire, and you will have to renew it, and then you will be confronted with these higher prices. So sooner or later, everybody will feel this.
To that point, moments ago, Italy's Mario Draghi was speaking, saying that the increase in energy costs requires urgent action. What tools do the governments have at their disposal to do those urgent actions?
Yeah, that's what I wonder as well, because in the very near term, there are not that much options. I mean, we can import gas from perhaps other countries, but then it should at least be available. And I must say that all the gas which is available, so which has not been sold by contract yet, mainly goes to Asia, because China up to last week was always paying more than we in Europe. So in the end, all the gas which is available goes to China up to the end of last week, because now we see higher prices here in Europe. And now you see that LNG shipping is changing their direction towards Europe more. But still, then, you need quite a lot to compensate for the lack of gas we see in this. And other options are perhaps lowering demand or to compensate it, for instance, with more usage of coal-fired power plants for power production. But that, of course, conflicts with our climate goals. So that's an issue. And on top of that, you see that, for instance, nuclear power plants in France are switched off because of unexpected maintenance. So it's really a problem, and I don't see very near-term solutions. So it seems for the short term, at least, that the only way is up.
Right. Well, I have to say it is really remarkable to look at maps on the terminal. You can see those shipping containers carrying LNG doing those U-turns. You were explaining, Hans, going from China, now going to Europe instead. What are the effects to see these drastically different flows of the natural gas market than we have been used to?
Yeah, well, it's quite familiar. We've seen it quite a lot in the oil market. But for gas, it's rather new. I mean, gas was always a regional market. And since the rise of LNG market, which is not that long ago, I mean, it's more from the last 10 years, we see that this happening. And most of it was contracted. So knew who was the buyer. So the ships were going there. And now you see that, due to high prices, some of these contracts are changing. So this is a quite new phenomenon in the gas markets. And it really makes it now a global market instead of a regional market.
Right, so a little more global, the LNG market, making it more like some other energy markets. Let me ask you about the EU's policy. You mentioned climate policies, Hans, in one of your earlier responses. And we should learn today how the EU plans to categorise natural gas and also nuclear energy projects under its green investment rules. What would you expect to see? What would be a surprise?
But you mean that it's a surprise that it was categorized as green, you mean? Or?
Yes. We're going to hear more about the taxonomy and what they categorize as green and what they don't.
Okay. Yeah, for me, it was quite a surprise to see that natural gas is categorized as green. I mean, it's a fossil fuel, and in that respect, it's a bit strange to see it categorized as green. On the other hand, you must realize that natural gas does play a huge role in the energy transition. So it's a transition fuel, which is very crucial. But of course, it's still a fossil fuel, and it leads to carbon emissions. For nuclear energy, it's a different story because nuclear obviously is carbon neutral, and therefore, whether you flag it as green, I'm having my doubts there. But in the end, it's a solution which is well familiar. We know how it works. It's a technique which is there already for decades, and it's carbon neutral. So in that way, it should play quite a big role in the energy transition and in the carbon neutral energy mix.
OK, we'll see how the science and the politics falls out on this one then. Hans van Cleef, ABN AMRO Senior Energy Economist, thank you very much for joining us. Coming up on the programme, a key figure in the fight against the pandemic. We'll bring you part of our interview with the AstraZeneca CEO, Pascal Soriot. That's next. This is Bloomberg.
Likely that this pandemic will be endemic over time. I mean, it is already more or less endemic in some geographies in the world, which means it will be like the flu. It will come back on a regular basis, and people may have to be vaccinated. And now the question is, do you need to be vaccinated every year, every 2 years? We don't know that, and it will depend on the durability of these vaccines.
The CEO of AstraZeneca there discussing the potential future of the pandemic. You can catch his full conversation with Francine Lacqua on the next episode of Leaders with Lacqua, airing tonight at 9:30 p.m. New York time for our viewers in the U.S. Now, for the Bloomberg Big Take, the major U.S. banks are making more money than ever with record bonuses to match. But there's a feeling that success in traditional Wall Street is being overshadowed by the riches pouring out of tech, crypto, and whatever Elon Musk is doing these days. In short, being a master of finance no longer means being a master of the universe. Bloomberg's Tom Metcalf is here to discuss. Tom, why this angst among the bankers?
Yeah, it's quite a sort of philosophical story in a way. I think there's a couple of things going on here. I mean, one is, like you say, just pure straight comparison with folk in crypto. tech or even people like Elon Musk. You know, bankers feel they are sort of used to being maybe top of the pay scale, and now they're looking around and going, wait a minute, folk in other industries seem to be doing way better than us. And then combined with that is sort of work-life balance, and I think the pandemic has made that even worse in that bankers are probably very aware of just how hard they're working. You know, you've had a record year, but that does mean a hell of a lot of deal flow. And so all that combined probably means they're looking at their trowel and thinking it looks a bit small on the money front.
Yeah, it was a really interesting read, today's Big Take. But this is supposed to be a really good year. I mean, not for the planet, perhaps, Tom, not when it comes to coronavirus, but in terms of the banking sector, the profits that have been made, the bonuses that look set to be paid. I suppose all that money, if you can't go on that, you know, great big holidays and spend it all, maybe it means a little less.
Yeah, exactly. And you're right. I mean, the money is going to be very good this year. So we're seeing bonus pools rise really across the industry. But yeah, I guess that's sort of the COVID effect, right? People have a bit more time to think about what they really want. And perhaps for some of them, it's not hours and hours in front of Excel spreadsheets.
Given sort of the existentialness, if I can invent a word, that you're describing, is there anything that can be done to improve how bankers feel next year?
Yeah, I mean, look, I think they'll probably feel a bit happy about themselves come February when these bonuses start to come through. That's, you know, the classic way of sort of boosting morale. But I think also we're starting to see, you know, maybe on the softer side, so perhaps some work-lifestyle balance adjustments. And you are seeing investment banks adopt a bit more of a sort of softer tone, even though it's sometimes quite hard to perceive, at least compared to historically. And that's all part of this move towards, we're trying to make this industry as attractive as possible for the top talent.
Tom, thank you very much. That's Bloomberg's Tom Metcalf on today's Big Take. And of course, you can read that by going NI Big Take Go on your terminal. Now we'll look at what else we're watching today. Anna, I'm watching out for consumer confidence measures from the Conference Board in the U.S. It hits the wire at 10 a.m. In New York. And these have been pretty ugly readings over the past few months. They've been deteriorating or in some cases disappointing. And really a lot of it has to do with inflation. You don't earn as much compared to inflation. It's getting more expensive. People have lower savings this time around. So it'll be interesting to see if that trend is continuing or maybe there's a little bit of a Christmas uptick in thoughts of how we're going in the economy.
Yeah, and you wonder if Omicron kind of cancels that out. But it has been interesting to see how consumers can feel a lack of confidence because of COVID-19, but then still come forward and spend. But as you say, maybe that was to do with the large bank balances that many people, or at least on aggregate, we went into this crisis with, or accumulated during the crisis. I'm watching the FDA, the Food and Drug Administration in the US, set to approve 2 COVID treatment pills, and this could come as soon as today. These are made by Pfizer and also made by Merck. And we're also hearing from the Biden administration, they've offered to support these companies in the production of these pills, including invoking some wartime powers, should that feel necessary. But what I thought was really interesting here, Danny, as well, is kind of the point that Kailey was making at the start. This comes on the same day that the UK has ordered millions of new antiviral pills, and we started this program talking about President Biden and his team planning 4 million doses. There's definitely an emphasis, certainly in these 2 countries, and maybe only these 2, on a new phase of fighting coronavirus, not with lockdowns, perhaps, and that's a big if here in the UK, but maybe with treatments instead.
Right. And look, there have been a lot of epidemiologists, a lot of various people we've spoken to who said you can't vaccine your way out of this pandemic, but can you perhaps add in these antiviral drugs? Yeah. Can that be enough, or does something else need to change?
Is this the way that you learn to live with COVID?
Exactly.
And if it becomes endemic, as everybody tells us it's going to be, then maybe we have to do that at some point. That is it for this hour. More surveillance, Bloomberg Surveillance is ahead. We'll be speaking to Dr. Baxi Hansoti of Johns Hopkins and Chris Harvey of Wells Fargo. All of those conversations still to come. This is Bloomberg.